The Fed has cut rates by 50 basis points, kicking off what could be one of the largest rate cutting cycles in history. And this has massive implications for crypto and the wider stock market. In fact, historically, rate cuts have had a massive impact on the markets. So I'm going to dive into just how big experts are saying that this rate cutting cycle could be. Historically, what we've seen happen in past rate cutting cycles, and maybe what we can expect to happen in this rate cutting cycle. And if we should be bullish or bearish on the coming rate cutting cycle, and what it means for crypto. We're also going to be asking the question a little bit later in the video, how likely are we to see quantitative easing during this rate cutting cycle? And if you don't know, that is something that could send crypto and the wider stock market absolutely skyrocketing. Before we get started though, keep in mind this is just my personal thoughts and opinions about the market, and in no way is it to be considered any form of investment advice. So first off, let's dive into what exactly is a rate cut. A rate cut is when the Federal Reserve lowers interest rates. These are the rates that banks have to pay when they want to borrow money. This means when the Fed lowers interest rates, it makes it cheaper for people and businesses to borrow money from the bank. Most people would probably commonly notice this when maybe they go to buy a house or to buy a car. Cheap rates is part of the reason we had this crazy housing boom in 2021. It was really cheap to get a loan, and a lot of people were taking out loans to go buy a new house. It also means businesses could take out loans to fund new expansions. And loans are a form of money creation because the money that the bank is lending you is being created out of thin air. When banks give out loans, they aren't handing out money that they necessarily already have. Instead, they're creating new money in the form of deposits that didn't exist before. This is called fractional reserve banking. It's how our banking system works. For every dollar in the bank might lend that dollar out 10 different ways. So for every dollar of value, they might create $10 worth of value, even though they don't have the actual cash to back the loans of the value they're handing out. So rate cuts lead to mass money creation via loans. On top of this, you have a variety of other effects that cause more liquidity to flood into the market and push asset prices up. First off, you have more people buying their homes and selling their homes. This allows those who've maybe experienced a decent gain. So say their house is appreciated in value, maybe they've made $50,000 or $100,000 in paper money because their house has gone up in value. It allows them to cash out and actually get that capital. And they might use that to roll into a new house, or maybe they'll take a portion of that and use it for savings or for spending or whatever. However you look at it, that money will now start cascading through multiple transactions into the wider economy, aka create more liquidity in the market. You also have people in 2022 and 2023 who took out variable rate loans when they went to buy a house. So they knew rates were high in the housing market, but they hoped rates would come down in the future and they would be able to lock in cheaper rates at that time. As rates come down, those people are going to be able to lock in lower rates on their mortgage, and that's going to translate directly into more cash left over for them to spend, invest, etc. every single month. You have cheaper business loans, leading to more jobs, more spending, and more economic growth. You have lower credit card rates, making it easier for more people to take out, let's say, credit card loans, but also those who currently are paying off credit card loans will now have lower payments and more cash to spend. This also means that the rates for T-bills is going to go down. That means all the capital locked up in treasuries today, sitting safe, nice, and comfy, is going to be compelled to seek out higher risk assets in order to get a better yield. That's a massive liquidity unlock that'll flow into the markets, including crypto. You have corporate borrowing, which leads to new projects and job creation. You have across the board more people taking out loans to make big purchases like a dishwasher or a refrigerator or a stove or a car or whatever. That, as we talked about earlier, not only leads to more money creation because the banks are giving out loans, that's a form of money creation, but also more economic stimulus because all this money is flowing into the economy because people are making these big purchases. And the list goes on and on and on. Lowering interest rates has a massive impact on the wider economy over time. Spread out over time, doesn't happen overnight. This is spread out over months, sometimes years. It has a massive impact on the economy and is a huge liquidity unlock and allows liquidity to flow into the markets. The basic picture I'm trying to paint is that rate cuts are a form of economic stimulus that the Fed uses to boost the economy. And it's typically a really powerful form of stimulus that can send stocks and crypto skyrocketing to new all-time highs. Now, past rate cutting cycles give us a hint or a clue as to what we should expect with this rate cutting cycle, specifically what we should expect when it comes to stocks and crypto. And I went all the way back to the 1980s to look and see how markets performed during past rate cutting cycles. And what I found was actually insane and gives us a huge hint on what we should expect to see this rate cutting cycle. And I'm going to share all of that in a second, but really quick. The Obsidian Council is my private research community where I share monthly research, my entire portfolio updated monthly with the exact allocation I bought and a ton more. We've had projects like Pendle, which went up over 1,500%. Projects like Solana, which is up over 740%. Akash, which is up over 1,000%. And recently Goon, which went up over 179,000%. Although, as a quick disclaimer on that last one, 179,000% is insane. We got really lucky with that one. That's far from normal and unlikely to repeat or happen again. We also have the airdrop guide, which some members made over $26,000 last year from airdrops alone, covering their membership for literally decades. I've personally made well over 100K between this year and last, and I share everything I'm doing personally with airdrops with the community via the monthly airdrop guide. And it is worth noting that airdrops have slowed down recently, and I'm not 100% sure where they'll go from here. I'm watching that space really close, and of course, I'm going to end up going wherever the opportunity is. The Obsidian Council is currently closed, but if you want to join, there's a link in the description of this video. Okay, so again, past rate cutting cycles give us a clue on what we should expect to see possibly this rate cutting cycle. And I went all the way back to the 1980s, looking at every single rate cutting cycle between the 1980s and today and how they affected the market. And I measured how much the stock market went either up or down during those time periods. And what I found is, in general, after a rate cutting cycle, the market tends to go up, with maybe the exception being the dot-com bubble, where the market did take longer than normal to actually hit a new all-time high. Rate cuts tend to send the stock market much higher, although we don't always see that happen directly after the Fed starts cutting rates. In fact, sometimes the market can dip before ending up going higher. This typically happens because the Fed typically is cutting rates in response to some sort of financial crisis. For example, the dot-com bubble, the 2008 financial crisis, during COVID, all these things were in response to some sort of financial crisis. So of course, right after the Fed started cutting rates, the market dipped in response because people started freaking out. It's also worth highlighting that we're talking about the S&P 500 here, and crypto is much more reactive to shifts in global liquidity than the S&P 500 is. During the 2019 rate cuts, during the same time that the S&P 500 went up over 80%, the crypto market went up a staggering 1,011%. And consider that rate cutting cycle was only from 2.5% down to 0%. Today, we might be looking at potentially a much bigger rate cutting cycle. So that begs the question, how low are experts expecting the Fed to end up cutting rates during this rate cutting cycle? I did a lot of research on this. I looked at a lot of expert opinions on what people are saying, especially people that tended to get things right in the past. Most experts are saying that they expect rates to get cut between 3.25% to as low as 2.5%. However, it's worth noting that the markets tend to vastly underestimate how low the Fed will end up cutting rates. I recently listened to a podcast with Macro Alf. He's like a well-renowned expert when it comes to like overall the macro environment, rate cuts, etc. And he personally thinks that the markets are potentially vastly underestimating just how much the Fed is going to cut rates, and that we could see rates go as low as 0% during this rate cutting cycle. Specifically, he said if we see weakness in the economy. So we'd have to have some sort of catalyst or a specific, like a recession or something like that in order for us to go down to that 0% mark. There has to be some sort of weakness or something broken within the financial system in order for the Fed to take it that low. And if that's the case, that would mean that in 2019, when we saw crypto go up 1,011% or whatever, that was only a 2.25% total cut. So they only cut interest rates by 2.25%. And if what Macro Alf predicts is true, like if we have some sort of recession or whatever, and the Fed is forced to cut rates down to 0%, that would mean that currently this rate cutting cycle, we could be looking at a 5.25% rate cut. So it's going from 5.25% all the way down to 0%. So much bigger in total scale as far as like the total amount getting cut. More similar to something like what we saw in 2008, which kicked off one of the longest bull markets in the history of the stock market. On top of that, keep in mind that although we might not have direct money printing like we did back in 2021, this time around, we will have mass money creation via loans being given out. And we still have all that money created back in 2021 sitting out there in the system somewhere. The money printed in 2021 isn't like loans or leverage, which can disappear when the loan's paid off or when people go insolvent. That is cold, hard cash that was printed and is still sitting out there. Most of it today is just sitting in safer assets because, rates have been so high, you haven't had to take much risk to offset inflation and keep your money being somewhat productive. But as mentioned earlier, as rates go lower, that provides more and more incentive for that capital to flee elsewhere, especially once rates drop below inflation levels. So when you're no longer making any money by having your money in treasury, but you're actually losing money due to inflation, that's a huge incentive for people to take that capital and invest it into riskier places. So, and sure, they're taking more risk, but they also have a lot more upside because with more risk tends to come more upside. So what does all this mean for crypto and the wider market as a whole? Well, as I outlined historically, rate cuts are extremely bullish over the long haul for the markets, and even more so bullish for crypto, which is a lot more sensitive to changes in global liquidity. And although this can take time, and sometimes these Fed rate cutting cycles can start with dips, it should end up being incredibly bullish for crypto, and it's more a matter of when, not if. Now, another tool that the Fed uses to stimulate the market that ends up massively pushing up prices is called quantitative easing, or QE. This is typically employed when rate cuts aren't working fast enough. So we've talked about rate cuts take time, and when the Fed needs things to go a little bit faster, they'll typically start doing what's called quantitative easing. It's basically when the Fed just starts buying all sorts of assets to add to their own balance sheet, pushing up prices, and it's a way to push more liquidity into the market. And to kind of get a feel for this, I did the same thing. I went back and I looked at a lot of different expert opinions of people who tend to be right about these sorts of things. And as of right now, most of them agree that it's very unlikely we're going to see any form of quantitative easing anytime soon. But that doesn't mean that things can't change quick. As I mentioned earlier, in the case of a recession or financial instability, the Fed tends to react very, very quickly to those sorts of things. So that could mean, again, rates going all the way to 0% if it was bad enough. And that could mean some form of quantitative easing to make the results happen quicker, which is a good argument for those who are maybe worried about a recession. There is an argument to be made that it would in the long term be somewhat bullish for crypto, because if we get a major recession, then rates are going to go down to 0% potentially, and we could potentially get some form of quantitative easing, and those things tend to send asset prices absolutely skyrocketing. Again, as a really easy reference point, think of what happened during COVID. Whole global economy got messed up. We had a huge issue with the financial system. Markets dropped. It was bad over the short term, but then we had rate cuts, we have quantitative easing, and markets ended up rallying back. They took back all those losses and went to new all-time highs, and we had really one of the most insane bull markets I've ever seen. Overall, rate cuts are unimaginably bullish for crypto, and I really don't see any argument or reason anyone can say otherwise. My personal opinion is that crypto is going much higher from here over the coming years. Nobody can stop what's coming, and the spice must flow. As always, none of this is investment advice. These are just my personal thoughts and opinions. Nobody can actually predict the future, and it's all really just me looking at the information and the data and then making educated guesses, or looking at the educated guesses of those that are experts that have maybe been previously right in the past, but there's no guarantee that they'll be right in the future. Make sure to sign up for my free weekly crypto newsletter. It's mostly just all the content I put out each week and an easy email so you don't miss it, but occasionally I drop some other cool stuff in there as well, including sometimes I do share projects in that newsletter before I ever talk about them in a video. And if you want to go more in depth, make sure to check out my podcast, the 1 to 1 Million podcast. Recently, I renamed my podcast from Never Die to 1 to 1 Million, and I do weekly episodes where I interview some of the biggest names in the crypto space, including I've had people like Sandeep, the founder of Polygon, Robbie, the founder of Immutable, Sriram, the founder of Eigenlayer, and a ton more. I also do in-depth research on various projects, the markets, and more. As always, if this video is helpful, make sure to hit that like button. If you have any questions or comments or anything to add, let me know in the comments down below. And if you want to see more videos like this, make sure to hit that subscribe button and the little bell next to it to be notified each time I release a new video. Thanks for watching, and I'll see you next week.